If you're confused about how super works or what fund you should choose, you're not alone. In fact, Finder data shows that 40% of Aussies are in the same boat. But with superannuation likely being one of the most valuable financial assets you'll have when you're older, now's the time to get your super sorted. If you're an Australian resident who's over 18 and earning more than $450 per month, your employer is legally required to pay a percentage of your earnings into your super fund. That money is your money, but unlike the pay that goes into your bank account, you usually can't access your super until you've retired. That's because the purpose of super is to fund your retirement. And even though that might feel like a long way off right now, you won't want to be caught short or forced to continue working when you're older. So how is superannuation any different to good old-fashioned savings? When your money goes into your super fund, it's invested into a range of assets like shares and property. The idea is that over time, your money will be worth a lot more than it was originally thanks to returns on those long-term investments. If you're already working, you might be thinking that you don't remember ever choosing a super fund. If so, you were probably given your employer's preferred fund, and if you've worked at several different jobs, you might even have more than one super fund in your name. Luckily, it's easy to consolidate into one fund or change your super at any time during your working life, and you can take that fund with you from job to job. So, which super fund should you choose? Just like banks, there are heaps of different super funds to choose from, each with different fees and investment strategies. So it's worth comparing funds to find the right one for you. Remember, this is your money, and the fund you choose now might make a big difference to your future. So when you're comparing super funds, there are 3 main things to look out for. Firstly, look for low fees. Ideally, you don't want to be paying much more than 1% of your balance in fees annually. That might seem low right now, but as your balance grows, so will the fee. You should also look at past performance figures, and you want these numbers to be high. It's best to look for a fund that's shown good performance over a longer period. So make sure you check out the 3, 5, and 10-year figures as well as the past year. Take this with a grain of salt though, as past performance doesn't guarantee future returns. Finally, choose an investment strategy that you understand and agree with. One fund might invest the majority of your super in shares, while another might invest in more low-risk or balanced options. Some funds will also take a sustainable or ethical approach to investing, meaning they may avoid supporting companies involved with things like fossil fuels, tobacco, or gambling. There's no right or wrong investment strategy, so take the time to make sure you choose a fund that sits well with you financially and ethically. Future you will thank you for it. If you're ready to choose or switch super, click the link below to read more and compare funds now. And remember to hit subscribe for more money hacks like this.